Hello students, welcome to BYJU'S IAS. Welcome to a session on economy this week, wherein we'll be taking up some of the very important articles that have appeared in various business related newspapers and we'll be analyzing these particular articles. For this particular video, I've chosen the time period from 25th of November to 8th of December 2019 and the articles that I've chosen are from Business Line, Hindu, Business Standard, Indian Express, Limit. Let's begin the discussion. The first article is related to the concept of GST compensation. Now, some of the very important points are: 1. Under the ambit of a GST, we have basically subsumed multiple types of indirect taxes which were earlier imposed and collected by the central government as well as the state governments. Now, since the state governments have given away the power of imposing and collecting indirect taxes, there would be certain problem with respect to the tax revenues that they would be collecting in the coming days. In simple terms, let's say hypothetically, earlier a state government such as Karnataka was imposing indirect taxes such as X, Y and Z. And under the ambit of GST, the state governments have given away this particular indirect taxation powers. As a result of this, what if in the future or what if in the coming days, the state government is unable to collect the right amount of indirect taxes? Now, to counter this particular problem of issue of revenue collection, under the ambit of a GST, we have introduced the concept of a GST compensation. So under GST, we have multiple slabs. That is, a tax rate of 0% is there, 5% is there, 12%, 18% and 28%. And under these particular slabs, we have kept certain goods and services on which we are going to impose the respective GST rate and collect the GST. But under this particular slabs, one of the very important slab is the slab of 28%. And on some of the goods which are under the 28% slab, apart from the GST rate, we also impose something called as compensation cess. Now, the cess that will be collected on these particular goods will be put into a fund called as a compensation cess fund. And from this particular compensation cess fund, the state governments will be given the loss of GST revenues or any under collection of a GST revenues. That particular lower collection of a GST will be compensated to the states by the central government. Now, on what basis the loss of GST revenues will be calculated? Let's say hypothetically, the same state government, Karnataka, in the year 2015 and 2016 has collected 100 crore rupees by imposing these three indirect taxes. Now, after this particular year, these particular indirect taxes have been subsumed under the ambit of a GST. So, whatever revenue that was collected in 2015 and 2016 will be taken as a base year revenue. And from this particular base year revenue, we assume that from one year to the next year, these particular revenues will increase by 14%. For example, in this context, the base year revenue is how much? 100 crore rupees. For next year, I assume the revenue collection to be 114 crore rupees. And the next financial year, it will increase by 14% over 114 crore rupees. In this way, we will keep on calculating what is the expected revenue collection for the state of Karnataka under the ambit of GST. Now, let's say hypothetically for the year 2019 and 2020, just hypothetical numbers, let's say the state of Karnataka was supposed to collect 180 crore rupees in the form of GST revenue. Now, what if rather than collecting 180 crores, the state government is able to collect only 150 crore rupees? So, expected revenue collection was 180 crores, but the state government was able to collect only 150 crores in the form of GST, or to be more precise, SGST collection. Now, the difference or the revenue shortfall here is 30 crore rupees. The central government would have imposed and collected the compensation cess, and the funds from the compensation cess will be taken by the center and will be paid to the state government of Karnataka. Whatever is the revenue loss or whatever is the revenue shortfall for the states, the full revenue shortfall shall be given by the central government by imposing and collecting the compensation cess. This is a basic idea of a GST compensation. What has been the issue in the recent days? The issue has been that from one year to the next year, we assume that the GST revenue collection for the states will increase by 14%. But in the recent times, the compensation cess collection has been much lesser. The GST revenue collection also has been much lesser. In simple terms, the compensation which is supposed to be paid by the center to the states is much higher than whatever is the compensation cess collected by the center itself. As a result of this, there has been a delay in paying the compensation to the states. There is a pressure on the central government to provide for full compensation for all the states. Now, apart from this, another very important point you must remember is this. The central government, though, will give compensation to the particular states for lower revenue collection under ambit of GST. This particular compensation shall be paid to the states only for a period of 5 years. That is, in 2017 GST has come into force. From 2017, next 5 years, whatever is the revenue loss will be compensated by the center. That is only till financial year 2022. And after the financial year 2022, right now there is no methodology to provide for compensation for the states. The problem with the states is this. The states are spending more money than the center. The states will have a very high amount of a capital expenditure, and in the present situation, there is a slowdown in the market. And to overcome this particular issue of a slowdown, we expect the center to spend more as well as the states to spend more. But if the revenue collection of the states will come under pressure, how can you expect the states to spend more? That is one point of consideration. And second point of consideration is, despite it being more than 2 years since the implementation of GST, we are yet to get any kind of a stabilization in the revenue collection under the ambit of a GST. The stabilization is very important because the states will have to decide their own expenditures based on the revenue that they collect from direct tax sources as well as indirect tax sources. If the revenue streams are not stable, are not constant, are volatile in nature, then it will have a big impact on the decision making process of the state government. And the third point of concern for the states, which majority of the states have raised, is what will happen after 2022. If the GST doesn't get stabilized, the revenue streams will remain volatile, which will put a larger pressure on the finances of the state government. And after 2022, they are not going to get any kind of a compensation from the center also. That is the precise reason very recently the states have raised a concern with respect to GST compensation and the delay in the compensation payment to them by the center also. So this is the basic discussion related to the points given in this particular article. Now, based on this, let's have a look at a question here. Consider the following statements. Under GST, states will be given compensation till the end of 2025 in case of a lower GST collection. This is wrong. The states will be given the compensation only for 5 years or till the end of 5 years since the implementation of GST. That will be till financial year 2022. Second statement, for paying the compensation, some of the goods in the slab of 18% are imposed with additional cess. This is wrong. The goods which are under the ambit of a 28% have been identified, and on this we have imposed the compensation cess. So both the statements are wrong. Right option will be option D. Both are false. The next article is related to insolvency of a financial service providers. Some of the very important points are: 1. In case of India, to provide for insolvency resolution, we have a very good framework for both the defaulters when they are companies and the defaulters when they are retail borrowers. Now, what do you mean by insolvency resolution? Very simply put, let's assume here is a bank, or in simple terms a lender, and this particular lender has given loan to a borrower in the market. Now, this particular borrower could be a retail borrower, a common man, or a corporate borrower. And if these particular borrowers default on the repayment, then there is a concept of insolvency and bankruptcy code which can be taken into consideration, and the lender can drag these particular borrowers under the insolvency and bankruptcy code either to debt recovery tribunal or to NCLT and recover the loans. This is a basic concept of insolvency resolution which is present as of now in case of India. But please understand, this particular process of insolvency resolution or the framework of insolvency resolution is applicable to corporate borrowers as well as retail borrowers. What about the companies or the institutions which are basically falling under the financial system? For example, what if there is a bankruptcy situation in case of a financial institution such as bank? What if there is an insolvency resolution of a pension fund which has to be conducted? What if it is an insurance company? So in these particular situations, right now we do not have a consolidated framework. To put it simply, we do not have a framework on the lines of insolvency and bankruptcy code. We have a fragmented framework. For example, if it is a bank, the insolvency resolution of a bank is usually conducted by RBI. Since RBI is the regulator, it will basically ensure that the insolvency resolution is conducted. More importantly, RBI will ensure that the bank will not declare bankruptcy. Even before a bank reaches that particular situation, RBI would have simply taken the bank, merged it with another bank, or would have done something else. But in simple terms, what I'm trying to say is, unlike the insolvency and bankruptcy code, we do not have a very good framework for conducting the insolvency resolution for financial institutions. To overcome this only, Government of India earlier had proposed the concept of FRDI, Financial Resolution and Deposit Insurance. But because of various oppositions to this particular bill of FRDI, Government of India had dropped or withdrawn the FRDI bill. And very recently, again Government of India is rethinking of introducing the FRDI bill with certain changes. Whether they will do it or not, you will have to wait and see. But what is more important in the present context is, in the recent times, there have been certain issues with the functioning of NBFCs or financial institutions in the market. For example, very recently, one of the biggest NBFCs, IL and FS. There was a scam in this particular IL and FS. Apart from this, there was also issue with Punjab and Maharashtra Cooperative Bank. So basically, some of these particular financial institutions or NBFCs, which are very important part and parcel of the financial system in India, are coming under a lot of financial pressure, and there have been certain issues with the functioning of these particular financial institutions. Now, to overcome this particular issue of addressing the insolvency resolution of financial institutions, very recently, Government of India has amended the Insolvency and Bankruptcy Code. And under this particular proposal to amend the Insolvency and Bankruptcy Code, now any financial service provider such as NBFC can be dragged to Insolvency and Bankruptcy Code by RBI. I'll repeat the statement. As per the amendment now, RBI can simply drag this particular financial service provider under the insolvency resolution process, or in simple terms, they can file a case against this particular financial service provider under NCLT, National Company Law Tribunal. Now, as a result of this amendment, for the first time, Diwan Housing Finance Limited, DHFL, has been taken to NCLT by Reserve Bank of India. Now, this is the discussion which has been provided in this particular article. But more importantly, you will have to remember this. Earlier, we did not have this particular provision where financial institutions would be dragged to NCLT. But now, with this amendment to Insolvency and Bankruptcy Code, those financial service providers which will have a net worth of at least 500 crore rupees can be dragged to NCLT by RBI. That is the regulator. And this particular amendment has been done by Government of India citing Section 227 as well as Section 239 of Insolvency and Bankruptcy Code. So this is the basic discussion provided in this particular article. Now, based on this, I have given a descriptive question. In the present context of increasing uncertainty and volatility in the financial market, there is a need for a special framework to address the insolvency issue. Elaborate. Now, please understand, this particular question has been given based on the recent issues which are happening in the financial market. That is, some of the banks are coming under a lot of financial pressure. Some of the NBFCs such as Island FS, right, are coming under a lot of pressure. The urban cooperative banks are under a lot of pressure, so on and so forth. So keeping in mind all these particular the pressure points in the system, I have given this particular question, and your answer should be surrounding the concept of Financial Resolution and Deposit Insurance Bill. Please read about this particular bill. You will have a very good answer to this kind of a question, because As already mentioned, for the corporate borrowers as well as retail borrowers, we have a consolidated framework for insolvency resolution process under the Insolvency and Bankruptcy Code. But for the financial institutions, right now we do not have a consolidated framework. Now, don't you think in this particular situation of uncertainty and volatility, we must be able to implement or bring in a law which will consolidate the insolvency resolution for all the financial institutions? That is the crux of the question given here. So, let's go to the next article. The next article is related to the concept of a fiscal deficit. Now, before discussing what is given in the article, let me tell you a concept of off-budget financing. Now, what do you mean by off-budget financing and how it is connected to this particular article given here? And here itself, I'll also tell you some of the very important observations are done by a CAG report in the recent times. Now, let's say hypothetically, Government of India this year allocates 200 rupees for food security. I'm taking very simple numbers so that the calculation becomes very easy. I'll repeat the statement here. Let's assume Government of India in the budget allocates 200 rupees for food security. Now, what do you mean by this? Government of India runs National Food Security Act, and under NFSA, let's say hypothetically, the beneficiaries have been identified and Government of India has announced an MSP of 20 rupees per kg of a certain crop. So, let's say hypothetically, using this particular MSP, the FCI will be able to procure 10 kg of food grains and supply it to the beneficiaries. Again, I am saying all of these are hypothetical numbers. So look at this. On one side, Government of India has allocated a total subsidy of 200 rupees for food security, and on the other side has announced an MSP of 20 rupees. So FCI, Food Corporation of India, can procure 10 kg of this particular food grain and supply it to the beneficiaries. Now, let's say after 1 month, Government of India will hike the MSP from 20 rupees to 25 rupees per kg. And when Government of India announces a hike from 20 to 25, it also means when FCI will procure the food grains from the farmers, rather than paying 20 rupees as they did earlier, now FCI will have to pay 25 rupees per kg. As a result of this, can I simply say that the procurement of FCI will come down from 10 kgs to 8 kgs? Now, what if FCI needs to supply 10 kgs? If they want to supply 10 kgs to the beneficiaries, then their expenditure will increase to 250 rupees. But the Government of India has allocated only 200 rupees. As a result of this, there is a problem with respect to the procurement. What usually government does is, this year it has already allocated 200 rupees. And if they want to ensure that the FCI procures 10 kgs, they will have to allocate 50 rupees extra. The problem is, if the subsidy given by Government of India is increased like this will lead to revenue expenditure expansion. And when a revenue expenditure expands like this, it will lead to expansion of a revenue deficit, which in turn might lead to expansion of fiscal deficit. So what usually Government of India tells FCI is, FCI should procure 10 kgs, supply to the beneficiaries, incur a cost of 250. But government in this year will be paying a subsidy of only 200 rupees, and remaining 50 rupees, which is supposed to be paid by Government of India to FCI, will be paid in the next financial year. Is it okay? I'll repeat the statement. FCI will be asked to continue to procure 10 kgs. The cost incurred by FCI will be 250. Government will pay only 200 rupees this particular financial year. Remaining 50 rupees will be paid by Government of India to FCI in the next year. This is basically referred as a concept of a rolling over of subsidies. Now, when Government of India rolls over the subsidies, it simply means FCI has to procure this extra 50 rupees from the market in the form of borrowing. So, FCI will procure the 10 kgs, incur a cost of 250 by borrowing 50 rupees from the market and taking 200 rupees from the government. Now, this particular idea of borrowing by FCI is nothing but a concept of off-budget financing. What do you mean by off-budget financing? The basic concept of a budget is, it is nothing but it's a withdrawal by the Government of India. So under budget, Government of India basically withdraws the money from the Consolidated Fund of India, but by taking the permission of the Parliament or prior approval of the Parliament. But in this case, government is incurring a cost of 250, but it has only withdrawn 200 rupees or taken the permission for withdrawal of 200 rupees from the parliament. Remaining 50 rupees, though it has financed, it has basically circumvented the parliamentary process. This particular process is called as off-budget financing. Now, what is the problem with off-budget financing? In the recent times, the practice of off-budget financing by the government has increased. When the practice of off-budget financing increases, these particular borrowings are not mentioned in the fiscal deficit numbers, but nevertheless, these numbers will be part of the overall debt of the Government of India. I'll repeat the statement. When Government of India practices off-budget financing, these particular borrowings which are outside the budgeting concept are not mentioned in the fiscal deficit numbers, but nevertheless they are part of the overall debt of Government of India. So CAG has basically warned Government of India or has raised flags against this particular practice of off-budget financing. It says by borrowing through the concept of off-budget financing, you are circumventing the budgetary process. You are basically bypassing the parliamentary procedures, and more importantly, your off-budget financing is very huge. You are borrowing very heavily from the market. For example, CAG says that if I go as per the Government of India's numbers, fiscal deficit is somewhere in the range of 3.3% to 3.5%. But if I consider the off-budget financing, which is nothing but the borrowings of the government itself, the overall fiscal deficit of Government of India will be more than 5.5%. So when Government of India says fiscal deficit is 3% or 3.3%, CAG says that Government of India is not giving the right picture to the parliament. This is a basic discussion related to the concept of off-budget financing as well as the CAG report. Now, how can I connect it to this particular article? All of us know that there is a slowdown in the domestic market. Now, what do you mean by slowdown? The GDP growth rates are actually declining. I'll repeat the statement. Slowdown basically refers to GDP growth rates are declining from one quarter to the next quarter. The previous quarter, the GDP growth rate was 5%. In the recent quarter, it is 4.5%, which represents a slowdown in the GDP growth rate. And this particular slowdown has happened because of the demand slowdown in the market. So now to prompt up or to increase this particular demand slowdown or to overcome this particular demand slowdown, Government of India needs to increase its expenditure. Why Government of India needs to increase its expenditure? Very simple. Remember this. In any economy, there are three stakeholders. Who are the stakeholders? One, household. Second is firms or companies. And the third one, very important, government. So whenever investment has to be done in the system, either it has to be done by household, firms or companies or by the government. Rather than using all of it, they will simply use the term public investment and private investment. And in recent times, what has happened? The investment from the private sector has come down. So it is the duty of the Government of India to increase its investment. But for Government of India to increase its investment, in the first place, it should know what is the correct fiscal deficit or the liability of the government. Only when the right fiscal deficit is calculated for the government, they will be able to prepare the borrowing strategy in the market, issue securities in the market, collect the money or raise the money in the market by conducting disinvestment process, and then spend the money so as to reverse this particular slowdown in the market. That is the crux of the discussion which has been provided in this particular article. So based on this, I have given a descriptive question. Though off-budget financing provides an opportunity for the government to raise revenues in the times of distress, it is a risky proposition. Discuss 250 words. The next article is related to P2P lending. Now please understand, as of now, there are multiple modes of lending and borrowing institutions in the market. For example, we have public sector banks, we have private sector banks, we also have cooperative banks, so on and so forth. Apart from these traditional types of banking or lending and borrowing institutions, in the recent times, RBI as well as Government of India have started promoting novel institutions or novel methodologies of lending and borrowing in the market. For example, in the recent times, RBI is promoting the idea of the small finance bank. It is also promoting idea of a payment bank, which are nothing but the concept of a niche banking or differentiated banks. Apart from these two types of lending institutions or banking institutions, One more very important type of a lending platform or a lending methodology which is being promoted by RBI is the concept of a P2P lending, which is nothing but a peer-to-peer lending. Now, what is this idea of a peer-to-peer lending? Peer-to-peer or P2P lending is nothing but a concept of a crowdfunding itself. Or to put it in simple terms, rather than approaching a bank or a financial institution and borrowing from this particular financial institution, under the ambit of a P2P, an institution will set up a platform. And in this particular platform, multiple lenders will get registered and multiple borrowers will also get registered. And this particular platform will be used by lenders to lend money and for borrowers to borrow the money from the lenders. This in simple terms is a concept of a P2P lending. And look at the name there, peer-to-peer means from lender directly to the borrowers. There is no mediator or there is no banking institution which is present here. Whatever is the company which is involved, it will only provide the platform. And this particular company will not be involved in the collection of the deposits as well as the lending of the money to the borrower in the market. And the institution which is providing the platform will also not be involved in lending the money to the borrowers in this particular system. What has been done by RBI in the recent times is to promote the availability of the credit to even other borrowers in the market. For example, those particular borrowers who do not have the collateral, they could easily borrow from this kind of a system. Because please understand, if I go to a bank, borrow from the bank, there is a concept of a collateral or a security which I need to provide to borrow from the bank. But in case of the P2P lending, basically there is no requirement of a collateral, or in simple terms, the loans which are given under the concept of a P2P are unsecured loans. And to promote more and more lending under the concept of a P2P, very recently RBI has increased the cap for the lenders to 50 lakh rupees. Now, what do you mean by this? Imagine there is a lender X. He would be registered on multiple P2P platforms. Earlier, the maximum exposure of a lending for this particular lender X was limited to 10 lakh rupees. Or in simple terms, he could lend on a single platform or a multiple platform, but the maximum loan that he is allowed to give was 10 lakh rupees. And very recently, RBI has increased this to 5-folds, that is to 50 lakh rupees. That is the important information that has been provided in this particular article. Now, apart from this, there will also be a borrower. What about the borrower? In case of the borrower, RBI has not changed the limit. The ceiling has not been changed. Even today, in case of a P2P, a borrower can borrow to a maximum level of 50,000 rupees across such platforms. So in case of a lender, this has been increased from 10 lakh to 50 lakh rupees, but in case of the borrower, it has been limited to the amount of 50,000 rupees itself. So this is the basic information that has been provided in this particular article. Now based on this, I have given a question here. Consider the following statements. NBFC P2P are regulated by SEBI? No, these are regulated by RBI, Reserve Bank of India. The maximum exposure for the lender on all the platform is 50 lakh rupees. Yes, that is correct. The maximum exposure for the borrower is 50 lakh rupees. No, that is wrong. It is 50,000 rupees. So the right option will be option B. Only second statement is true. The next article is related to MUDRA loans. Now please understand, in case of the MSME sector, micro, small and medium enterprises, one of the biggest issues that these MSMEs face is the availability of credit. What is the problem here? Problem is these particular enterprises do not usually have a credit history. And majority of these particular MSME sector will basically fall in the unorganized sector. As a result of this, they do not have the concept of maintaining record books. They do not have the concept of maintaining credit history or preparing the financial statements. Now, when these particular MSMEs will approach a bank to get a loan, usually banks do not prefer or banks are hesitant to give loans to these particular companies. Why? For a simple reason, as a lender, I should know what is your credit history. I should know how much revenue you are generating. I should know how much profit you are making. I should know how much order books are there with you. But in case of MSME, right, usually these are not present. As a result of this, it becomes very difficult for the MSMEs to borrow from the formal institutions such as banking sector. Now, to overcome this particular issue of availability of the credit in the MSME sector, Government of India launched a scheme called as PMMY, Pradhana Mantri Mudra Yojana. And Mudra basically stands for Micro Units Development and Refinancing Agency. Under the concept of Mudra, Government of India basically introduced the concept of a refinancing, wherein the banks will be refinanced on the loans that they give to MSME sectors. And rather than focus on MSME sector, Mudra Yojana basically says the loans shall be given to non-corporate and non-farm small businesses or small and micro businesses. So under the ambit of Mudra, loans from the banking sector will be given to non-corporate, non-farm, small and micro businesses. And under the concept of Mudra, we basically had three types of products. These are 1. Shishu, Kishore and Tarun. So these three types of products or loan products were provided, and the value of the loans will start from 50,000 rupees and will be maximum 10 lakh rupees. In case of a Shishu, the loan value will be up to 50,000 rupees. In case of a Kishore, it will be more than 50,000 up to 5 lakh rupees. And in case of a Tarun, it will be more than 5 lakh up to 10 lakh rupees. Under the ambit of Mudra, the loans of value up to 10 lakh rupees could be provided. Now, apart from this, another very important piece of information that has been provided in this particular article is that Pradhan Mantri Mudra Yojana was launched in the year 2015. Now, what is the important message given in the article? In the recent times, majority of the loans which are given by the banks under the Shishu are becoming NPAs, non-performing assets. The banks are very much wary for a simple reason. They are saying that whenever they are supposed to provide these kind of a Shishu loans to businesses such as let's say cycle shops or pawn shops, they are unable to conduct the business appraisals. That is, they do not know how to conduct or evaluate the business model which has been provided to them. And in these particular situations, what usually happens is they will end up giving the loans, and businesses, when they take loans over a period of time, let's assume they will shut the shop. As a result of this, these particular assets will become non-performing assets. As a result of this, it has been seen that in last financial year, totally under the Mudra Yojana, the banks have issued loans of up to 3.2 lakh crore rupees. That is in the financial year 19. And in this particular financial year, the disbursal of loans under Mudra Yojana has slowed down. Till the end of November, the banks have issued loans of worth up to 1.5 lakh crore rupees under this particular Yojana, which is less than 50% of the total loan value issued in the last fiscal. So this is the information that has been provided in this particular article. So based on this, I have given a question here. Consider the following statements about Mudra. It was launched in the year 2014. Wrong. It was in 2015. The objective is to ensure that the credit is available for non-farm, non-credit, small and micro enterprises. Yes, true. The maximum value of loan under the scheme is 5 lakh rupees. Wrong. It is up to 10 lakh rupees. Right option will be option B. Only second statement is true. Thank you. Have a good day.